Welcome back to Stock School Daily.
They released targets for the second half of 2026, so
Mhm.
later this year, of $400 to $500 million.
Which, on its own, is already a massive leap for a company this size.
But then they dropped the 2027 target, $2 to $3 billion.
It's audacious. There is no other word for it. It really is.
Okay, I'll play the skeptic here because that's my job. I could put $3 billion on a spreadsheet right now. It doesn't mean anything. When a tiny company projects revenue that large, usually the market just laughs it off. So why should we take this seriously? How do they even claim they're going to generate that kind of cash?
That is the right question to ask. If they were just, say, selling software licenses, the math wouldn't work. You'd need millions of customers overnight.
Impossible.
But the report details their strategy. The AI Data Monetization Network. They're planning to expand this network to over 100 cities across the U.S.
So it's an infrastructure play.
It's a data utility play. The value here isn't just the software itself, it's the data being collected and processed. In the current AI landscape, high-quality real-time data is the new oil.
Look,
And it is a big if, but if they can successfully deploy to 100 cities and monetize that data flow, the revenue per hub starts to add up very quickly. They are banking on volume. They're effectively saying we are building a nationwide grid for AI data.
all right, so the how is this 100-city rollout? But that just brings me right back to the skepticism. Building anything in 100 cities is hard. It's expensive. If I'm a short seller sitting on 42 million shares, I'm looking at that and saying, prove it. Show me the tech is even real.
And that is exactly why the January 8th news is probably even more important than the revenue numbers, at least from a credibility standpoint.
The IBM connection.
The IBM connection.
Right, the expanded collaboration with IBM. Now, we see partnerships in the microcap space all the time. Sometimes it just means a company is using IBM Cloud and wrote a press release. Is this that, or is this something substantive?
The language in the source material is very specific. It mentions deploying enterprise-grade AI at the edge in major hubs like New York City and Philadelphia. And it notes that this is an expansion of an existing collaboration.
At the edge. Break that down for us. Why does that matter technically?
So historically, AI processing happened in these giant centralized data centers. You send your data to the cloud, it gets processed, the answer comes back.
Which takes time.
It's slow. Edge AI means processing the data right where it's collected on a local server on the device itself. It's faster, it's more secure, and it's absolutely essential for any real-time applications.
Okay, so it's sophisticated stuff.
Extremely. And here's the thing about IBM. They don't typically mess around with penny stock partners unless the technology solves a real problem for them.
Right.
IBM is trying to dominate the hybrid cloud and AI market. If they're actively deploying DVLT's tech in a place like New York City, it's a huge form of third-party validation.
It's a seal of approval.
It's a risk reducer. If you're a short seller, your whole bet is that the company is worthless. But if IBM is installing their tech in Philadelphia, well, the company is clearly not worthless. The tech works.
So now you're going to zero thesis is dead in the water.
Exactly. The question just becomes, how much is it worth? And that shift from, is it real, to how much is it worth, is what can kill a short thesis. The IBM news provides the floor. The revenue targets provide the ceiling.
And the space between the current price and that ceiling is where all the action is.
That's where the volatility happens.
But there's one more piece to this puzzle.
Yeah.
You can have great tech, you can have huge targets, but if nobody knows you exist, the stock just drifts. We see good companies with low volume all the time. To squeeze 42 million shares, you need buying. You need eyes on the screen.
Which brings us to the third catalyst, visibility. On January 14th, Datavault announced a partnership with fintech.tv.
I see fintech.tv screens everywhere. They're on the floor of the NYSE, they're in airports. It's a major platform.
It is. But look at what they're doing. This isn't just some advertising deal. They are launching a patented AI bias meter and a polling system.
An AI bias meter. I saw that in the notes. It sounds like a buzzword salad. What does it actually do?
Well, think about who's watching. Traders, hedge funds, algorithms, they all consume news, but news has bias. If an AI can quantify that bias in real time, saying this article has 60% negative sentiment, that's a valuable piece of data for a trader.
For a risk management tool.
Exactly. So they are putting their product inside the very show that the traders are watching.
It's like live demo.
Constant live demo. And look at the timeline. The pilot season runs from January through April 2026.
That lines up perfectly with the window for this whole short squeeze setup.
It's probably not a coincidence. While the short sellers are sweating, the company is broadcasting its technology on global financial television every single day. It completely solves the obscurity problem. A trader sees the tool working, they might look up the ticker.
And that drives interest, which drives volume, which puts more pressure on the shorts.
It feels like a coordinated pincer movement. You've got the fundamental attack with the revenue, the technical validation with IBM, and now the PR attack with fintech.tv.
It's a perfect storm scenario. The report we have calls it a high volatility setup for a reason. They aren't being subtle. They are firing on all cylinders at the exact moment their stock is most heavily shorted.
Precisely.
So let's talk about the scoreboard, the price. Right now, DVLT is trading in the, 74 to 78 cent range. It's a penny stock.
It is.
But the analyst targets in this report are, they're a lot higher.
Significantly. Target 1 is $4.
It's about a 5x from here.
And target 2 is $7. That's nearly a 10x.
Those are massive gaps. But before we even think about $4, we have to talk about the elephant in the room.
The $1 mark.
$1 barrier. Why is that dollar mark so critical? Is it just, psychology? People like round numbers?
It's partly psychology, but it's also structural. A lot of institutional funds, pensions, mutual funds, they have very strict mandates. They literally cannot buy a stock if it's trading under $1.
So they're locked out of the game.
They're locked out. But if the stock breaks $1 and holds it, usually for 10 days or so, suddenly those restrictions get lifted. A whole new pool of capital becomes eligible to buy the stock.
Which would just add more fuel to the fight.
Exactly. For the short sellers, $1 is the line in the sand. Below $1, they feel safe. It's just a penny stock. If it breaks $1, it graduates. And if it graduates, the buying pressure could overwhelm them.
So if you're watching this stock, that's the level to watch.
Absolutely. If it crosses that Rubicon, the dynamics of the squeeze change completely.
We started this by talking about cognitive dissonance.
Yeah.
The difference between the 42 million shares betting fail and the company screaming success. It really frames the market not as a calculator, but as a battleground of narratives.
That's what it always is, ultimately. The shorts are looking at historical data. They're looking at the balance sheet from 6 months ago, the cash burn, the simple fact that it's a penny stock. And based on that data, they're right to be skeptical.
But the company's selling the future.
The bulls are looking at projected data, the IBM deal, the revenue guidance, the potential of the AI network. The squeeze happens when the future suddenly arrives faster than the past expected it to.
And usually, the Goliath in these situations, the huge short interests, they win these battles. They have deeper pockets.
Usually, yes. But the risk profile here is what we call asymmetric. If the shorts are right, the stock maybe drops to 50 cents. They make a little bit of money.
Okay.
But if they are wrong, if that IBM deal is real and revenue starts coming in, the stock could go to $4. The shorts can lose 400%, 500% or more. That is a dangerous, dangerous trade to be in.
High volatility indeed.
If you found this helpful, hit that like button and subscribe for more.